Revenues include sales plus a few other sources of cash, such as payments received for royalties or patents. The next line is often cost of goods sold. Sometimes you'll just see cost of sales. This is exactly what you'd think it would be. Cost of goods sold is the direct cost of making the company's product, such as the salaries of the manufacturing employees, the cost of the steel, and the natural gas to produce the energy to run the factory. The difference between revenues or sales and the cost of sales is called gross profit. To get to net profit, we need to subtract indirect costs of producing the stuff we sold. Farther down the income statement, you'll find other expenses listed, and eventually you'll get to operating income. This is an important number because it's the profits that the company earned from its regular business during the reporting period. There may have been gains or losses from asset sales or restructuring charges and other non-recurring events, but operating profit represents what the company earned from its previous operations during the period covered. After those non-recurring items comes the provision for income taxes. If you're thinking of the corporate income statement as being similar to our personal tax returns, then this is the accountant's best guess of the amount that the government will take. What's left is net income, or the bottom line of the income statement. The cash flow statement is the third big financial statement that people use in evaluating a company's well-being, and as I noted earlier, it has been likened to your checking account statement. It's the bridge between the balance sheet and the income statement. Lots of analysts look at cash flow statements before anything else, and I can see why they might do that. If you decided to analyze your personal financial position, where would you start? Like most people, you probably start with your checking account. If you look a little more deeply at your checking account statement, you'll be able to tell where your money came from and where it went. There's a deposit for your salary and $100 from good old Uncle Pete for your birthday. You wrote a check to Lowe's for a new washing machine, have quite a few debits for gasoline, bought more groceries than you expected, and so on. That's the gist of the cash flow statement. It usually has three parts. First, there's cash flow from operating activities. This is the heart of the statement because it accounts for cash flows tracing to a company's business. For Carnival Corporation, this would be its operations as a cruise and vacation company, for example. The second component of the cash flow statement covers cash flow from corporate investing. You may have sold your old washer to the newlyweds down the street for $50, which you deposited in your account. Maybe Carnival raised some cash by selling a ship. Both you and Carnival had a cash inflow from selling an old asset you no longer need. Finally, the third component is cash flow from financing activities, like getting a loan or paying interest. That debit to Toyota Financial Services is the last one, and now that car is all yours. By comparison, Carnival may have paid off some maturing bonds. In both cases, cash went out the door to settle a debt. The idea behind the cash flow statement is to track the changes in a company's cash position. Given its name, that's no surprise, is it? To track those changes, accountants and analysts start with net income and then adjust it for things that affect net income but didn't affect cash. You might be asking, how can something affect income without affecting cash? Think of your car. When you bought it last year, it was worth, let's say $20,000. Now, though, it's a year older and has another 20,000 miles on it. Do you think you could still get $20,000 for it? Nah, potential buyers would see the extra wear and tear on it, and they'd cut their offering price. You might get $18,000, but not the $20,000 you paid for it last year. That $2,000 decline in value means that all else equal, you lost $2,000. But $2,000 didn't leave your pocket. An asset you owned wore out a little bit. It depreciated. Your income for the year is down $2,000, but your cash position didn't change because the car wore out. But you might object, I didn't sell my car, so I can't have income on it yet. Doesn't matter. Financial statements try to reflect reality,